Okay, so reduce taxable investments. What a lot of investors do is they will prune or sell off investments that have lost value before the end of the year, and take the tax loss as a reduction to other taxable income. So, next is tax sheltered investments. So as a tax shelter investments, you don't pay taxes until you withdraw that money. So you're investing with pre-tax income rather than after-tax dollars. For most people, that is advantageous because you're going to be in a lower tax bracket when you use that money. You have tax-deferred investment growth. The traditional, your 401k or 403b, those are the best examples. IRA, if you qualify, you can have tax exempt investment growth with a Roth IRA. The difference being with a Roth IRA, you're making contributions with after tax income. So, but that money, it grows tax free as long as you withdraw that money after 59 and a half. You would not be taxed on it. If you do not qualify for a traditional IRA for the deductions, you'd be better off to create a Roth IRA. So it's something to consider. So other examples, the Coverdell Education Savings Account, qualified tuition programs, or 529 programs, government savings bonds. You can buy government savings bonds, and the interest is tax exempt if you use it for education. Tax exempt municipal bonds. The vast majority of municipal bonds, state and local bonds, are exempt from federal income tax. Capital gains on housing, there's a one-time elimination. I think you have to be 55 to qualify. I think it's $250,000 for individuals, or $500,000 for a married couple. You can make a capital gain on the sale of a home and not pay taxes. You can also, if you reinvest it, it's not taxable as well. So, other strategies to reduce taxes. Defer income. Push your bonus. If you work for a small employer, a lot of times you can push your bonus into January, so you'll be paying the taxes the following year, and you have time to plan for that tax liability. Accelerate deductions. Take advantage of all your legal deductions. Shift income to a child. Children would typically be at a lower tax rate. This is something that wealthy people tend to do. They will purchase a rental property and put it in the name of their child, and the whole thing will be taxed at a lower rate because the child has little or no income. Buyer managed real estate investment. Real estate is one of the, real estate and oil and gas are the two types of investments that, if you are an active participant, you receive tax preference. That is not the case if you buy, invest in oil and gas and you're not an active participant. So need to be careful there. Take pass-through deduction on business income. All right, so let's start with concept check 4.3 on the next lecture.